Welcome to the Explainer. Today, we're unpacking some truly wild numbers from a titan of the modern financial world, Interactive Brokers, and their absolutely explosive Q 2026 earnings. Honestly, this is a masterclass in how to capitalize on a perfect economic storm, all while building the technology of the future. So let's jump right in.
Okay, I want to start with a number that should honestly stop you in your tracks. 67%. That is the year-over-year surge in customer margin loans over at Interactive Brokers, which pushes their total to a massive $108.5 billion. Now, what does this actually tell us? Well, it tells us we are in a massive, aggressive, risk-on environment. Retail and institutional traders alike are taking on some serious leverage to ride the current market momentum. They aren't just investing their own cash anymore. They're borrowing heavily to buy even more stocks. And this single metric right here, it's the engine behind the incredible quarter we're about to analyze. Section 1, the margin loan boom and Q2 financials. So to really understand the financial machinery driving these records, we have to talk about net interest margin, or NIM. Think of NIM as simply the spread. Interactive Brokers pays a certain interest rate to customers on their uninvested cash, right? But then it charges a much higher interest rate when customers borrow money for those margin loans we just talked about. And in an environment with elevated central bank rates and with $108 billion in margin loans out there, this spread effectively turns the brokerage into an absolute free cash flow machine. And you can see the direct result of that machine right here. Look at this massive top-line revenue growth. Net revenues jumped from $1.48 billion in Q2 of 2025 all the way up to a staggering $1.90 billion in Q2 of 2026. This is being fueled by a really powerful combination of heavy borrowing and high trading activity. The math is just working out beautifully right now for Interactive Brokers, mostly because investors are betting that their market returns are going to more than offset the higher financing costs of borrowing. Breaking down exactly where those billions are coming from reveals two distinct engines, and they're both firing simultaneously. First, you've got the traditional trading fee engine, commissions, and that's running hot at $673 million. That's up 30% on higher options, stocks, and futures volumes. But then look at the net interest income. That is driving a massive $1.06 billion. So both of the broker's primary economic engines are working perfectly together. When traders borrow money to buy stocks, the broker collects that fat interest spread. And when trading activity inevitably picks up, commission revenue follows right alongside it. Now, the absolutely crucial point is how this all translates to profitability. Check this out, a 77% pre-tax profit margin. I mean, that is just a jaw-dropping figure. It marks the 7th consecutive quarter that Interactive Brokers has maintained margins above 70%. And to fuel this even further, they're sitting on a record $182.4 billion in uninvested cash on the platform. Even with clients heavily investing their funds into the market, a 34% growth in new customer accounts has driven this cash pile even higher. Because with competitive interest rates, Interactive Brokers is frankly just a really attractive place for clients to park their idle money. Section 2, AI and platform innovations. So, why this massive 34% influx of new users? Well, it's largely because Interactive Brokers is leaning heavily into agentic AI trading to build the user experience of the future. They've rolled out this thing called the IBKR connector, which is built on the Model Context Protocol. This lets users literally connect AI platforms like ChatGPT, Claude, or Grok directly to their brokerage accounts. It's wild. Here's how the flow works. Step 1. You use a natural language prompt, like maybe you ask the AI to analyze your portfolio's exposure to clean energy and suggest rebalancing. Step 2. The AI preps the trade instructions. But crucially, they use a human-in-the-loop paradigm. The AI cannot just execute on its own. You have to review and approve it. Then step 3, once approved, the trade executes across their 17+ global markets. It is completely transforming how investors interact with their portfolios. But beyond AI, they're aggressively expanding their global and product footprint too. They recently became the very first e-broker to offer trading in Korea, which gives clients direct access to those highly sought-after Korean memory chip companies. They've also launched a unified 24/7 prediction markets platform. This lets clients trade event contracts on literally everything, from political election outcomes to climate data, like hurricane landfalls. Add in the recent expansion of crypto trading across Europe, and it is super clear they are strategically capturing global, institutional, and retail interest. They're offering products you just can't get all in one place anywhere else. Yet despite all these flashy new features, June 2026 brokerage metrics prove that Interactive Brokers remains hyper-focused on best execution. The net expense to their clients as a percentage of trade money is hovering around a tiny 0.023%.
By routing orders directly to venues that offer the best price and by capturing liquidity rebates, they manage to keep costs incredibly low. And honestly, that is exactly how they retain high-volume, highly sophisticated traders. Section 3, the interest rate vulnerability. All right, so we've got record revenues and cutting-edge tech. But what happens to this beautifully tuned cash machine when the macroeconomic environment inevitably shifts? This quote from an independent investment analysis really hits the nail on the head regarding the underlying risk. The market is pricing in sustained leverage, leaving little room for a contraction in borrowing volume. Basically, buyers of this stock are effectively betting that both equity momentum and interest rates will just stay high indefinitely. The multiple on the stock right now reflects a core belief that these record revenues are the new normal.
Think about it. The current environment is the absolute best-case scenario for a modern brokerage. You have high treasury yields plus rising stocks, which equals wide interest rate spreads and really confident borrowing. But consider the risk environment for a second. If we see a meaningful shift to Federal Reserve rate cuts combined with a market correction, the spread earned on customer cash compresses. And even worse, if stock prices fall sharply, it could trigger margin calls, shrinking that massive $108 billion loan book way faster than investors are currently expecting.
And management has actually been very transparent about exactly what that interest rate risk looks like mathematically. Every single 25 basis point cut in the U.S. Fed funds rate strips an estimated $81 million in annual net interest income straight from Interactive Brokers' bottom line. Plus, add to that another $38 million hit for every 25 basis point drop in non-US dollar benchmark rates. If the era of higher for longer interest rates finally comes to an end, a really significant chunk of their revenue engine is going to naturally cool down.
Which leaves us with this final, really thought-provoking question to ponder today. If interest rates do drop and that net interest margin compresses, can trading volume and their new AI-driven product expansions actually fill the void? Interactive Brokers has clearly built a fortress of a platform, but the health of this trade relies so heavily on the macro environment. Will traders keep borrowing if the music stops? Thank you so much for joining me for this explainer. Keep a close eye on those monthly margin balances, and I will see you next time.